All right, guys, my name is Abdurrahman Badat. I'm here on behalf of Finance today. We are one of the organizations that provides Islamic contracts for purchasing residential properties, be it primary or investment. What we're going to do today, inshallah, is we wanted to kind of go over the do's and don'ts for individuals that are looking to purchase a home. It might be your first time, it might be your second or third time, and you just need a refresher. So just wanted to kind of go through with everyone, make sure everyone's well educated on the do's and don'ts of the home buying process, how to get the most bang out of your buck, and how to, inshallah, make the process as streamlined and as stress-free as possible, inshallah. So purchasing a home here in the United States is a huge step, right? It's some people call it realizing the American dream, where you've come maybe as an immigrant, maybe you're a first generation born individual here, and you want to lay your roots down here. So it's a very big step, almost a rite of passage, if some might say. Being knowledgeable about this process, it's going to help in many aspects. That you're going to be able to save money. Like I said initially, you'll have a less stressful process going through it. You'll know the ins and outs, and you'll know when to say yes, when to say no, and when to step back. And one thing to keep in mind is that a home purchase is usually someone's biggest purchase they'll make in their life, right? If you're looking at a purchase of 300, 400, 500,000 K and up, that's a pretty large purchase that everyone may not be making on a daily basis. So how we'll go through it is I'm going to touch on a few subjects such as credit and PMI, and then we'll run through the process. We'll jump into our Murabaha contract for a bit as well, and then towards the end we'll open it up for question and answer. If you'd like to ask your questions in a group, please feel free to do so. If you'd like to ask them privately, we'll be here after Isha as well, inshallah. So, credit. Now, credit is one of those necessary things that we have to take part in to be able to show how financially responsible we are, how far stretched we may be on debts, and how much more, I guess you could say, how much more kind of space we have in our spending as well. So in purchasing a home, your credit's going to be a very important factor. It's going to determine your profit rate. It's going to determine your qualification. It's going to determine how much money that you can actually, how much money you may need to put down and how much home you can buy, what you'll get approved for. So your credit's going to play a very vital role in this. As I said, it's going to be a key factor for your mortgage qualification. It'll impact your down payment. Good credit helps with lower down payments. Our down payments start at 3% for first-time home buyers and can go up to as high as you'd like. And it'll be your profit rate as well. A good tool that we like to share with all of our clients is annualcreditreport.com. So be in the know about your credit. Know what liabilities you have on your credit. Keep an eye on it, at least on a monthly basis. Ensure that you don't have anything going into collections. There's a lot of times you may be paying on something, a small medical bill, or maybe you forgot you had a line at AT&T and you switched over to Metro PCS, and you forgot to pay the last month. They'll put it in collections and then impact your credit very strongly. So annualcreditreport.com, what this is going to allow you to do is pull a free credit report once a year from all three bureaus, TransUnion, Equifax, and Experian, and it will be a soft credit check, so you will not have any impact on your score in this situation. So why is our credit history so important? The history of making your payments on time shows that you are responsible with your funds. Not over borrowing shows that you stay within your means. And anytime you have an account free of derogatory marks, such as bankruptcies or collections, once again, it'll indicate that you're responsible at handling your debt. You take it, and then you pay it off in a timely manner, if not sooner, without being late on your payments. So how do you keep your credit score high? What you want to do is use it to purchase low-priced items, right? Maybe have a card that you use on a monthly basis to purchase gas, or you purchase only your groceries on it. Pay it off. It won't accrue any interest at that point. Pay it off before your cycle ends, and it'll show your card paid off. It'll help boost your score. Pay your bills on time, right? Any medical bills, any utility bills, even your credit card and other bills, make sure you pay those on time, and that'll help keep your score at a healthy level. One derogatory mark can really damage your score. So we've worked with clients who had impeccable credit, right? These folks were in the high 700s, maybe the 800s. Things happen in life, right? It's understandable. You forget, bill didn't get paid. People's scores come down up to 50 points sometimes on one small thing. That it'll take one instant for that score to drop, and then building it back up takes a lot more work and a lot more time as well. Your utilization of your credit. So you want to make sure you're not using more than 30% of the available credit. You have a $1,000 credit line on your American Express. Try to keep it below 300 and then pay it off. Don't close out your unused accounts. You may have opened up a Home Depot credit card, right? You were getting a 12-month interest-free deal on it. You're like, let me take advantage of it. You bought what you need. You paid it off. Don't close it. Closing your accounts, it lowers the time that your credit was active, and then it'll lower your score as well, because now you have less credit, and so your utilization from your other cards gets a little bit higher. Finally, be patient. As I mentioned earlier, certain credit blemishes take time to repair, right? For example, a bankruptcy. A bankruptcy is gonna show up on your credit report for at least 7 years. There's usually no other workaround to being able to get those removed. If so, those processes are kind of pricey, and they do take a lot of time. Building your score back up does take a little bit of time. So at a minimum, make sure you put aside at least 3 months if you need to build your score up, 3 months, and then strategize how you're going to pay it off to build that score back up. So what impacts your credit history? So here we see a couple of percentages. So 35%, your payment history contributes to 35%. So paying your bills on time, that's going to be a huge indicator on your score, right? It's a huge chunk of it. Credit utilization contributes 30%, which is another large aspect. Make sure that all your usage is at 30% or below. Anything higher, then it gets tougher sometimes for us to be able to approve you at a lower down payment or approve you for the full amount that you may be looking for. The average age of your credit, 15%. So as I mentioned earlier, don't close those unopened account or unused accounts, because taking those off will reduce the age of your credit. Mix of credit, about 10%. So you want to have, you have some credit cards, maybe you have an auto loan, maybe student loan, so you want to have a mix of credit as well. And then finally, 10% is hard credit inquiries. So when we're pre-qualifying you, or if you're, signing up for a new credit card, looking into purchasing a vehicle, those are going to be hard credit inquiries. They're going to look into your credit score and your report, and those will bring your score down slightly. The best way to bring that up, once again, that's going to impact us by 10%. However, we come back to our payment history, make sure we make our payments on time, and we can level our scores off. Now, employment and income qualifications. So if you are employed, you're a W-2 employee, work for someone other than yourself, it can't be your own company and then you giving yourself a W-2. This would need to be a separate entity giving you a W-2. So we're looking at about 2 years of continuous employment history in the same or similar role. So you can move up, no problem. You can move industry, so you could be let's say, you might be an accountant for a law firm and now you've moved into the medical field as an accountant for a hospital. No problem, you're still in that same line of work. In this situation, there are a couple of loopholes that you can get around. One of those is if you're a student, right? So you're a student at University of Houston, you're studying accounting, right? You get your first job, let's say at PwC, you're working 6 months, you say, you know what, I think I'm ready to buy a home. In this situation, what we can do is we can actually utilize your schooling history as employment history, because it shows that you were trained in that field and now you've secured employment in that field. So we can use that for 2 years. So it doesn't necessarily mean that you have to be in a job for 2 years. There are certain loopholes in this situation. And then I'll jump into one more loophole on that. For example, maybe you took some time off between work, right? Had a child, had to travel, getting married, took a month or 2 off. As long as you're back at work, your pay is not less than what it was previously, we can explain certain gaps. So if there's some gaps, we want to try to keep them at a minimum. However, if we have valid reasoning, we can definitely explain those gaps. And as long as our combined history is at 2 years, we can qualify you on that. Now, for self-employed individuals, business owners, this individuals, maybe truck drivers, Uber drivers, you would fall into this category as well. Or maybe you're not getting paid on a W-2, you're getting paid on a 1099. We need to look at 2 years of tax returns if you've been in that business for less than 5 years. If you've been in that business for 5 years or more, we only need to look at 1 year tax returns. How we qualify income is that we have to look at either your Schedule C, your 1125s, your corporation returns, and then we have worksheets on our side that the investor requires us to run income through. So, there could be certain things that you may have written off on your taxes as a self-employed individual. Certain things we can add back. We can't add everything back, unfortunately. And we want to make sure that our income, our final income, our gross income, our net income is not in the negatives. That can be, sometimes you can make it work, but sometimes it'll work against you. And for that situation, if you have any questions, if you're like, hey, where do I stand today? I'm not ready to buy today, I might wait a little bit. Please do reach out to myself and my colleague Zahid, and we'd be more than happy to run those numbers for you as well. Now the down payment. So on a primary home, the minimum down payment for first-time home buyers that we can qualify is at 3%, as long as that fits within your debt-to-income ratio. And we'll cover the debt-to-income ratio in our next slide. Without any special programs, if you're not a first-time home buyer, maybe you don't qualify, then our minimum would be 5%. And then keep in mind, anything below 20% on a primary home will require PMI or private mortgage insurance, and we'll talk about that a bit more in one of the future slides as well here. If you're looking to purchase an investment property, put it out on rent, get some, generate some income for yourself, we're looking at a minimum of 20%. Right now, the way the market is, we highly suggest putting down at least 25% just to get better rate consideration and better qualification odds. And so what we'll do is we'll jump into our debt-to-income ratio. So what the debt-to-income is it compares your monthly debt. So this will be any monthly liabilities that show up on your credit report, right? So we're not going to look at the full amount, right? Maybe your American Express has $1,000 on there, but your monthly payment is only $25. So what we're going to do is we're going to look at that $25. So any existing monthly liabilities, this is from your credit report. Other things that could come into play here could also be if you have any child support liabilities, if you have any other, legally required liabilities, those are what we're looking at. We're not going to look at your monthly gas expense, your monthly utility expense. Those things we won't look at. That's going to be compared to along with what your future housing expenses will be. So existing monthly liabilities plus your existing liability for the home you're looking to purchase. So this will include your principal, your profit, your property tax, homeowner's insurance, and if there's a homeowners association, the monthly breakdown of that will be compared against your monthly gross income. Generally, you want to stay within the 43 to 45% range. Anything past that, we've seen approvals up to 50%, but at that point, you want to have stellar credit, maybe in the high 700s or into the 800s, and you want to have very low utilization as well. So it's not impossible, but it is tough, and in this market, my suggestions would be stay within that 43 to 45% range. If you can be lower than that, then that's even better. Now, private mortgage insurance. So if a borrower cannot afford the 20% down payment, right? You know, it happens, 20% is a big chunk of money in a lot of situations. What we'll do is we'll look at the contract's gonna be looked at as a riskier investment, and you're gonna be required to take out PMI, or private mortgage insurance, as a part of getting the mortgage. Now, PMI protects the lender or the investor in the event that you default on this primary obligation. And it costs about 0.5% to 1% of your mortgage, and it's usually included in your escrow payment. So you're gonna pay it all in one, along with your monthly mortgage payments. And once you reach your 20% equity, you can remove it. You don't have to pay it any further. At Devon, we have two options for your PMI. You can do a one-time fee, which you would pay at closing. We recommend paying that one time upfront if you plan on making minimum payments over the course of your entire term. However, if you say, hey, you know what, I'm gonna put minimum down payment today, I'm gonna be getting a bonus in December, I'll be making a $20,000 lump sum payment and get to 20%. At that point, we'd recommend that you take the monthly option. What the monthly option is gonna do is it's gonna break it down into smaller pieces, and you'll get to keep a little bit more money on hand, because by December, once you put that lump sum payment down and you reach your 20%, you can cancel your PMI. So technically at that point, you've only made a few months of PMI payments and overall saved that remaining cost. So how's the process gonna go? So first of all, you wanna get pre-qualified. So that's when you call myself, you call my colleague Zahid, or any one of our colleagues at Devon. What we'll do is we'll get you to fill out an application, submit some documentation, and then we do a hard credit check, so that will impact your score. One of the tips that we like to let everyone know about is when you are making a large purchase, such as a home or a car, the credit bureaus have stated that, say you want to shop around, you want to see who's going to get you the best deal, where you're going to get the best service. You can shop multiple organizations or lenders, and if you do so within a 1 month period, your score will only be impacted once. We like the 2 to 3 week window better. The 1 month can sometimes be slightly troublesome, so we recommend staying within 2 to 3 weeks, but if you plan on shopping around, have everyone run your credit within that 2 to 3 month period. What that's gonna do is you're not gonna take multiple hits, your score won't constantly come down and then impact you once you are looking to lock a profit rate in. Once you're pre-qualified, now it's time to look for homes, right? So one of the questions we get, and in the past when we've done these presentations, we've had realtors with us, and a lot of people ask, hey, should I have a realtor? Why do I need a realtor? My personal opinion on this is have a realtor. It's, number one, it's not costing you any money. There's no money coming out of your pocket to pay the realtor for their services. The seller is the one who's responsible to pay them. So you're essentially getting this service for free. Number two, they know the ins and outs. They understand the laws and regulations. They have to go to courses. They get certified. So they know what to look for. A lot of your realtors know how to negotiate. They have access to certain tools that we don't, right? They have access to the MLS. The MLS allows them to do a little bit more in-depth research about the property. When was it sold previously? Have any upgrades been done, and these types of things. So they can really get this information, and they can be your ally in this situation. So my recommendation, do get one. If you don't know anyone, or if you don't know who to work with, always reach out to us. We have many great brothers and sisters here in Houston that we can refer you out to as well, who specialize in different parts of the city also. So we've identified our home, we have a contract, you put in your bid, you've won the bid on the home, we have our contract. So what do? Now we're gonna prepare you for processing. So processing is essentially where we're structuring your file, we're getting your documents, we'll cover the documentations here shortly, and we're submitting it to the financier or to the underwriters. Once the processing is done, it goes into underwriting. Underwriters are going to look through your file very in-depth. So they're gonna do a deep dive into your documents. They're gonna make sure you have a good financial history. They wanna make sure that you're no issues with employment. They're gonna really look into a lot of things here, and then they'll give you your initial decision. So 99% of the time, your initial decision is gonna be conditional approval. Hey, we approve this individual, but we need A, B, C, D, and E addressed first. So what we do is we'll be tying up any loose ends. There may be questions saying, hey, why was there a gap in employment? We see this on our credit report, what's going on here. Can you finalize your homeowner's insurance? These types of questions. And then what we do is you work with your Islamic finance specialist and gather those documents, get everything signed and submitted, and then it goes back to underwriting. And at this point, what's gonna happen is underwriting can do one of two things. If they're satisfied with the answers we've submitted, they can say you were approved, let's get ready for closing. And there are situations where they can say, hey, we actually have a few more questions, can you provide us A, B, and C? Now, once we have our final approval, underwriting has signed off on it, we've made sure the funds are in the account, we've made sure that your employment, your credit, everything's good, then we prepare for signing. So closing date, you go into a title company, or you can have a mobile notary come out to you. You go in and you're basically gonna be signing documents for about 45 minutes. And after all the signing is done, the money goes through, you get your keys. So what's pre-qualification? So pre-qualification, it refers to the initial estimate of how much home you can qualify for, So what you wanna do in this situation is you wanna get pre-qualified, right? A lot of times realtors may not even take you to go look at properties without a pre-qualification letter in your hand, right? They wanna make sure that their efforts are gonna be fruitful in this situation. You wanna determine what your price range is gonna be. This is the time where you can figure out, hey, what are my monthly payments gonna look like, right? Maybe you don't wanna exceed $2,500 a month. That's your ultimate budget right there for housing every month. You don't wanna exceed it. So what we do at that point is, we can work with you to say, hey, you know what? If you wanna stay at $2,500 a month on your monthly payments, it might be best to only purchase up to X amount. Don't go any further, or your payments can go higher. And in this situation, how we get you pre-qualified is we'll have you submit an application, do a hard credit check, verify income, verify assets, and if everything goes well, we run our approvals on the back end, and we'll issue you this letter. So how much home can you afford, right? So we're gonna look at your credit history. We're gonna look at your available cash for your down payment. We're gonna look at your income. We look at gross, not net in this situation, and any existing debt and obligations. Remember, we talked about the DTI, so that's what that plays into the DTI. And then we wanna look at our max mortgage amount plus the down payment will equal what your home purchase price range would be. So now we have 647,200 down here. So what 647,200 is that's called the conforming limit. So every year, this number gets revised. It depends on the way they see the markets moving, right? So for example, we were in the mid 500s last year. So 647,200, the conforming limit, is the max amount that you can get financed. So you can buy a home up to $1 million or $2 million. However, you can't finance more than that 647,200, at least here in Texas, right? Now, if you're out in areas where you're not going to find anything in that range, such as California or maybe certain places northeast, they have higher limits. But since we're here in Texas, we'll focus on this 647,200. So you want to make sure you don't finance any more than that 647,200. Worst case, you're like, hey, I really love this house. This is what I can put down, and I want to finance more. We do have an additional product called a jumbo. I'm not going to touch too much on that. If you guys do have any questions, do feel free to reach out about the jumbo. But we can go up to $250,000 above that 647,200 limit. Now, what documents will we ask for? So we're going to ask for W-2s if you're not self-employed. We're going to ask for your 2 most recent pay stubs. We're going to ask for bank statements. So we want to see the bank statements showing the funds that you'll be using for down payments and closing costs in the accounts. Maybe you have your funds in a 401k, or maybe you have them in a brokerage account. You can show us those. Say, hey, you know what? I'm going to use my Robinhood account for my down payment. I'll be transferring my funds over once I find a home. That's perfectly acceptable as well. We'll look at personal tax returns as well. This will be both for self-employed and employed individuals. And then we'll need identification documentations, driver's license, passport, social security card, permanent resident card if you're not fully a citizen at that moment. Property or homeowner's insurance quote. You can do these online. You can reach out to maybe the agent that you work with on your car insurance or any other insurance, and they can help you with that. Finalized purchase agreement, so an agreement signed by both you and the sellers stating that, hey, we're going to sell it to our buyers here at this price with this down payment, and we want to close by this date. Now, when we spoke about the conditional, this is what we'll use to submit to underwriting initially. Once the conditional approval is issued, there are additional documents that can be requested by the underwriters. You generally won't see them asking for anything too far-fetched. It'll be things that are fairly easily accessible, but just be prepared. Try to have things on hand. Try to kind of keep in mind if we have to do any explanations to, type that up and go from there. So I'm going to jump into our murabaha now. Is anyone familiar with the murabaha or what it entails? Yep. Okay. So the murabaha is essentially a cost plus sale paid off in installments. So a very simplified way to think about this, this might be oversimplified, but I'll go ahead and state it anyways. You're driving home tonight, realize, hey, I need a gallon of milk, stop at H-E-B, grab a gallon of milk, right? So H-E-B probably purchased that gallon of milk for $1. You go in there, you're paying them the profit of $1.50, so you're in total paying them $2.50 for that milk. So that's going to be paid, and then you're purchasing that product. So that's how it'll be structured here. What we do is, during closing, Devon actually purchases the home first. So we purchase the home. The home is deeded from the seller to Devon. Now we are owners of the home, and we attach our profit to it. Our profit rate will be determined through the use of the qualification process, through your credit, your down payment, and your equity. And we attach that profit, and then we say, hey, this home was $250K, you're putting $50,000 down payment, this is $200,000 that we're gonna pay for it, plus the profit, let's just use a flat amount here, $100K. So when we sell it to you, we sell it to you at a full $350,000 minus your $50,000 down payment, so you'll be paying that $300,000 off over the course of the 10, 15, 20, or 30-year term that you qualify for and choose to go with. In this situation, one of the questions that comes into play is, hey, what if I make extra payments? by all means, you're allowed to make extra payments. Making extra payments can help you successfully close out your contract sooner and with paying less profit over the course of your term also. And you'll actually sign a document stating that you won't be penalized by paying sooner. So you can get a discount on the murabaha by paying it off sooner. So we have a document here. It might be a little tough to see. I've got some copies of it up here as well. So this just goes through the murabaha in 5 steps, essentially purchasing the property. We purchase it. First deed from seller to Devon, second deed from Devon to you. It's going to be at a fixed price. We'll tell you the total. That'll be on our murabaha agreement. And at closing, you pay the down payment, and then you continue making your payments over the course of time. Now, a lot of people like to say, well, you're essentially just switching words here. What's the difference? It's not, it's still the same thing. So, it's what our contract's going to be based upon. That is a huge indicator of taking it out of the aspect of interest, right? So our contract here on the Islamic side is no longer based on the lending of any money. Rather, what we're going to do is base it on the actual home. So you won't have a mortgage note. A mortgage note is generally a security instrument that's used in the financial world to ensure payments on any debts that you may have. So there will be no mortgage note in your closing packet. You will not be signing for any debt upon money. Rather, what we do is we have our murabaha agreement in place of that. That'll have your full amount that you would pay over the course of the 30 years. Now, just really quickly want to jump into some myths that you tend to hear about Islamic finance. And if anyone would like any of these documents, do shoot us an email and I can share this with everyone. So aren't you simply replacing interest with rent or interest with profit? As I mentioned, no, we're not, right? It's actually coming down to the contract. There's not going to be any sort of mortgage note in there. There's not going to be any sort of debt upon money. Rather, it's going to be an installment sale on an actual asset, which would be the home. Why do Islamic banks charge more for home financing than a conventional bank, and how is that Islamic? This may have been true previously when it was first starting out. Alhamdulillah, we're at a point now where Islamic financing has a large demand. The general public and our back-end investors are seeing the value in it, right? Muslims, we take any money, we borrow anything, or if we're making a contract on a purchase, we're usually very good about paying it back to the point where our back-end investor actually likes the Muslims because they tend to always pay as opposed to your general society. But coming back to this, we really don't. If we compare Islamic financing versus your traditional banks or others, we're fairly similar. In some instances, yeah, you might get a better profit rate, you might get something better, but then we have to keep in mind as well, Islamic financing in the United States is, I would say, about 20, 30 years old, right? We're a very young market right now. As we grow in demand, as we gain some more momentum, then we can bring more things to the table. However, at this point, we're not more expensive or anything of that nature. I would say we're fairly equivalent in that situation. And then one of the final myths that you hear a lot, it's inherently less competitive, and you're always going to be asking me for extra paperwork and extra documentation. That's absolutely false as well. At most, with Devon at least, you'll have one additional transaction, so that'll be the second deed. You may be looking at a cost of maybe $100 or $200 extra. Nothing crazy, nothing too out of the ordinary. And then in terms of documentation, we're looking at the same documents a lot of individuals are going to look at. A lot, you can go to Chase Bank, go to their mortgage department, they're going to ask you for the same documents. So here's a small murabaha example. So, this kind of goes over the numbers over here. So Muhammad and his family are purchasing a condo, which costs about $240,000. So Muhammad works with Divan Islamic to purchase the condo. What Divan does is they'll purchase the condo from the seller for $240,000. That was the initially agreed upon price. And then we're going to sell it to Muhammad for $286,000. That's going to be paid in monthly installments over a 15-year period. The scheduled monthly payments at that point, not including the insurance and taxes, would be about $1,586.21. And the $286 that Muhammad would pay for his condo would be a fixed amount paid to Divan, which owns the home at this point, right? Any extra amount that Muhammad would pay at this point, it goes towards principal and would reduce his overall profit that he would pay. Now we'll jump into late charges, right? Late charges are applicable. If you do not pay by a certain date, a $50 late fee will be assessed. However, that late fee is not added to your principal and compounded over time, as you see on the conventional side. And additionally, Divan Bank cannot profit from that either. That's going to be, because that wasn't part of our original contract, so that's not profit for us. We actually have that. It goes into a charitable trust, and then it's granted out to community organizations within the Chicago area where we're headquartered, as well as on a national level. Now, finally, where can we offer our services? So as we mentioned, most likely if you're looking to be a first-time home buyer, we offer our services in Texas. Along with Texas, we offer them in about 33 other states. Keep in mind, if you're looking to purchase an investment property, you don't have to live in the state that you're looking to purchase if it's not going to be your primary home. So you can run transactions in any of these states while you reside in Texas, at least for investment properties. Or if you plan on moving, maybe changing a job, then you can go into those states as well, and we can help you out with that. So we'll wrap it up now. I think we still have some time for Isha. We have 15 minutes? Okay. So what we can do is we can open it up for some questions and answers, inshallah. If you guys have any questions that you'd like to ask in a group setting, or if you'd like to ask us privately afterwards, we can do so as well. Yes?
So you were saying the profit decreases if you pay early.
Correct.
But I thought the amount is fixed. So how do you reconcile these two things? Like a fixed amount, yet a reduction in the profit?
So that's where the product would fit into the U.S. housing model as well. So the way these products have been designed, if we look at any type of Islamic financing right now in the United States, it's been designed to fit within the Islamic guidelines as well as the U.S. housing guidelines. So per the U.S. housing guidelines, and as I mentioned, you sign a prepayment penalty notice, which says that you cannot be penalized for any payments. That dictates that you can reduce your profit over time. I think you need to. Oh. So basically, we're talking about the fixed amount. So what happens in that situation is if you do make those early payments, we would forgive the remaining balance at that point. So it is initially fixed. If we look at it in the sense of repayment, a lot of times you will have a smaller percentage of people that would pay it off sooner. It's generally not going to be the whole 100% that take on it that are going to pay it off sooner. So that fixed amount stays valid for them. However, in certain instances, if people do choose to pay it off sooner, we would forgive that remaining amount. So your debt wouldn't go up, however, we can bring it down. So we do have our approvals through the Sharia Supervisory Board of America. And if you look at the latest UMJA approval, we are considered able to be used through them. So this was the, I want to say, the latest fatwa from UMJA that was issued in 2014.
For everyone or for those in need?
I believe it's for those in need, yeah. So if you don't qualify from certain ones, we're an option as well. Mhm. Any other questions? Inshallah, so we'll go ahead and wrap up then. Jazakallah khair. I really appreciate everyone kind of sticking around after Maghrib. And like I said, if you guys have any questions, feel free to reach out to us personally. We'll be here until after Isha as well, and we can chat about anything that there may be. Jazakallah khair. Assalamu alaikum.